October 29th, 1929. Black Tuesday. In a single day, the U.S. stock market lost $14 billion. By the time the panic subsided, nearly $30 billion had vanished, equivalent to roughly $500 billion in today's dollars. But there's a darker story rarely taught. While millions suffered, a small group of powerful men didn't just survive the crash, they helped shape the conditions for it, positioned themselves to profit enormously, and emerged far richer. These weren't fringe speculators. Many were the very bankers and insiders the public trusted to safeguard the system. The common narrative portrays the crash as a blind, equal opportunity disaster. That's a comforting myth. In reality, it was a transfer of wealth, one fueled by leverage, manipulation, and asymmetric information. Some men saw it coming. Others actively bet against the very institutions they led. The banker who shored his own bank. Start with one of the most brazen cases, exposed only after years of investigation. Albert Achin Wiggin, chairman of Chase National Bank, the largest bank in the United States. At the time, between September and December 1929, Wiggin secretly shorted more than 42,000 shares of his own bank stock. Short selling means borrowing shares, selling them high, then buying them back lower after the price drops to pocket the difference. The steeper the fall, the bigger the profit. Wiggin wasn't gambling blindly. As head of the bank, he had intimate knowledge of its balance sheet, its leverage, and the dangerous speculation rippling through the system. While publicly supporting the market, he bet against it through personal corporations. When Chase stock plunged, he walked away with approximately $4 million in profits, about $72 million in today's money. Even more shocking, after retiring, he was initially granted a $100,000 annual pension. It took the 1932 to 1934 Senate investigation, led by Chief Counsel Ferdinand Pecora, to drag these facts into the open. During gripping hearings, Wiggin calmly admitted everything. At the time, no law explicitly prohibited a bank president from shorting his own institution's stock. Pecora called it one of the most reprehensible acts he had encountered. Public outrage eventually forced Wiggin to relinquish the pension, but he kept the millions. This wasn't an isolated scandal. It reflected a culture where personal gain often trumped fiduciary duty. The master speculator? If Wiggin embodied quiet institutional betrayal, Jesse Livermore represented theatrical brilliance and high-stakes drama. Known as the boy plunger and one of history's greatest speculators, Livermore made roughly $100 million in 1929 alone, equivalent to about $1.8 billion, today by orchestrating one of the most sophisticated short-selling campaigns ever. Livermore had studied the market for years. He recognized the fatal flaw. The 1920s bull run was built on extreme leverage. Brokers let customers buy stocks on just 10% margin, borrowing $9 for every one they put up. Rising prices masked the risk, but any sustained drop would trigger margin calls, forced selling, and a cascading spiral. He didn't create the fragility, but he spotted it early. Starting in early 1929, Livermore quietly built massive short positions across multiple brokers and accounts to avoid detection. He used proxies to execute trades. This was less trading than a calculated military operation. He also mastered crowd psychology. As long as public confidence held, the bubble inflated. He waited patiently for internal pressures to build. When the break came in October, Livermore was perfectly positioned on the opposite side of the panic. On Black Tuesday, while others faced ruin, he profited immensely. Legend says his wife, hearing news of the crash, asked if they had lost everything. Livermore reportedly replied that they hadn't enabled yet to confess that the national disaster had made their family extraordinarily wealthy. Livermore's story ended tragically. Later losses, personal demons, and the psychological weight of boom and bust cycles led to his suicide in 1940. Nearly broke again. But in 1929, he stood atop the financial world, having called one of history's greatest collapses with precision. The question lingers. If Livermore could see it so clearly, who else knew and acted? Pool operators and the architecture of manipulation. The 1920s boom wasn't purely organic growth. It was amplified by deliberate manipulation through pool operations. Coordinated schemes run by wealthy syndicates. Here's how they worked. A small group of insiders pooled capital, often tens of millions. They targeted a stock with decent fundamentals but low volume. They accumulated shares quietly, then hired tipsters, journalists, and newsletter writers to hype the stock with rumors of insider buying and explosive potential. Retail investors piled in, chasing the rising price. At the peak, the pool operators sold into the frenzy, offloading their holdings at inflated values. When buying dried up, the price collapsed. The operators extracted profits cleanly. Ordinary buyers were left holding devalued shares. This playbook repeated across stocks like Radio Corporation of America, Montgomery Ward, General Motors, and Sinclair Consolidated Oil. The market rose not solely on economic progress, but on orchestrated pumps followed by dumps. Joseph P. Kennedy, patriarch of the Kennedy family, participated in such pools and understood the mechanics intimately. Critically, he began liquidating his holdings well before the crash, shifting into cash, real estate, and hard assets. When the collapse hit, Kennedy was largely on the sidelines and positioned to buy distressed assets later. Franklin D. Roosevelt later appointed him the first chairman of the Securities and Exchange Commission, SEC, in 1934. Quipping that it takes a thief to catch one, Kennedy never apologized for his earlier tactics. The Pecora Commission documented pools involving elite names: Charles Mitchell of National City Bank, Percy Rockefeller, and partners at J.P. Morgan. The financial establishment had treated the stock market like a private extraction machine, harvesting savings from a trusting public. The investment trust trap. Another devastating vehicle was the investment trust, marketed as safe, diversified exposure to the market. In theory, sound. In practice, many were leveraged time bombs. Goldman Sachs launched the Goldman Sachs Trading Corporation in late 1928. It quickly spawned Shenandoah Corporation, which in turn launched Blue Ridge Corporation. Each layer bought shares in the one above. Compounding leverage, public investors bought at peak prices, trusting prestigious names, and the promise of professional management. When the crash hit, the trusts didn't merely decline, they imploded. The Goldman Sachs Trading Corporation fell from $326 per share to $1.75. By 1932, a loss of over 99%, Blue Ridge dropped from $24 to under $2. Goldman's partners, who had received discounted founder shares and sold heavily beforehand, largely protected themselves. Retail shareholders suffered catastrophic losses. Economist John Kenneth Galbraith later described this as one of the era's most striking speculative manias, highlighting the deadly asymmetry. The architects understood the risks, the buyers did not. The quiet winners, buyers of the ruble, while short sellers and pool operators captured headlines. Another group profited over the longer term. Those with liquidity who bought assets at fire sale prices. After the crash, wealth didn't vanish, it changed hands. Over-leveraged owners faced margin calls and foreclosures. Factories, farmland, buildings, and real estate flooded the market at fractions of prior values. Commercial real estate in New York dropped 50% or more in many areas. The Rockefeller family seized the moment, acquiring land and beginning construction on Rockefeller Center during the Depression, when labor, materials, and property costs were at generational lows. When recovery came, they owned prime assets bought cheaply. Cash-rich, bias consolidated industries. Companies that went bankrupt were acquired for pennies on the dollar of replacement cost. The Federal Reserve's contraction of the money supply made cash king. Every dollar gained purchasing power as prices fell. Burna Baruch famously sold out before the crash. While assuring the public all was well, J.P. Morgan partners admitted practices amounting to legalized bribery. Nothing was strictly illegal at the time because the rule makers were often the beneficiaries. The resulting reforms were landmark. The Glass-Steagall Act separated commercial and investment banking. The Securities Act of 1933 and Securities Exchange Act of 1934 mandated disclosure and created the SEC. These changes worked for decades, yet the deeper lesson endures. Crises born of leverage, opacity, and misaligned incentives. Don't destroy wealth so much as redistribute it from the trusting and leveraged to the informed, liquid, and ruthless. The 1929 crash wasn't a natural storm. It was assembled over years through excessive borrowing, coordinated hype, and structures that rewarded insiders. Ordinary investors believed they were writing genuine prosperity. Many were actually funding a leveraged casino. The names evolve, but the mechanisms persist. Information asymmetry, proximity to capital, and the ability to act before the crowd determine who wins when bubbles burst. History keeps the receipts. Every generation that forgets them eventually pays the price.